everyone seemed so bullish on AI. Are we in a bubble? What indicators do you look at? Like, what are the different metrics you're tracking right now that tell you, yes, we are?
One of them is the underlying fundamentals. The underlying fundamentals of AI-related companies are terrific, but they're not growing fast enough to justify the premiums that they command. In general, take the dot-com bubble. The dot-com bubble was built on a narrative that the internet will change everything. True, absolutely true. The narrative went on to say these are the dominant players in the internet and they'll remain dominant, and that wasn't true. Disruptors get disrupted. The third part of the narrative is the timeline. The narrative was this is going to happen shockingly fast, and it didn't. A very similar narrative is happening with AI. This is going to change everything. But adoption will be slower than people think. Humankind embraces change grudgingly and gradually. And B, we don't know who the dominant players will be in 10 years. It won't necessarily be anyone that's on our radar screen today. Intel was one of the 5 most valuable companies on the planet at the top of the dot-com bubble. So was Nokia, of all things. 5th most valuable company on the planet, Nokia. So narratives get ahead of themselves. How does it unwind? There's one thing happening today that could slow the correction of bubble pricing today, and that is the surge of money into index funds. It is overwhelming, and it drives a wedge between the value of companies that are members of the index and companies that aren't. The spread in valuation between members of the S&P 500 and the Russell 1000 and non-members was near parity in 1995, 30 years ago. Now it's 2.5 to 1. So then the narrative will say these are better companies. These companies down here, they're garbage. They're not very interesting at all. And in point of fact, they are small cap. They are value. And as a result of that, they're at deeply depressed relative multiples. But here's a fun fact. Non-members have had earnings and dividend growth over the last 30 years that's faster than members. Not a lot faster, but faster. If you have faster growth and you're paying 40% as much per dollar of earnings or dividends, you're going to get a higher return from these bargains.